I'm Mark Gagan and you're listening to the Voice of Insurance podcast, produced in association with Advantage Go, now part of Sapiens, enabling enterprise-scale underwriting through a single pane of glass. Today's guest is the CEO of an $8 billion GWP global insurance business. Ivan Gonzalez has spent 25 years travelling the world within the Swiss Re organisation, from his native Colombia to positions in New York and China. He now runs Swiss Re Corporate Solutions. After undergoing a turnaround process a few years ago, this is an organisation that has regained its strategic direction and confidence and is now posting combined ratios in the 80s. So it's from a position of strategic strength that this conversation developed. Ivan is an excellent guest because his passion for the role shines through and won't allow him to mince his words. He's demonstrative and you quickly understand where he stands on any given issue. Given Swiss Re Corporate Solutions' global capabilities and market relevance, that means we could have long and very detailed discussions on all the key market issues of the day. As such, the global corporate solutions strategy, the opportunities arising from the global data center boom, the application of AI in insurance, and AI as a newly emerging peril, as well as the growth in MGAs, all get the same unambiguous treatment. Ivan is a strong and charismatic leader who's fun to talk to. He's a dream guest, and this makes for a highly recommended listen for anyone looking for clues on how to navigate a global market now clearly entering a softening phase. Enjoy the podcast. Ivan, welcome to the Voice of Insurance.
Thank you for having me. Great to be here.
For anyone who's listening out there who doesn't know you, why don't you briefly introduce yourself and run us through your insurance career today? And maybe we'll start with that question that where everybody asks each other when we first meet in insurance. If we don't know each other, we always ask, how did you get into insurance?
The famous question, huh? I think for me, like for many other people, a bit by accident. I grew up in Colombia, in South America, and I did my studies there, and I was doing an internship at a Colombian-owned reinsurance company. And you know that in many high-growth/emerging markets where the insurance market are not as developed, you've had either the government owning some reinsurance companies or the local insurance companies forming a pool that acts as a reinsurance company. And that's what happened in Colombia. So the local insurance companies had formed this reinsurance company.
What was it called?
It was called Reaseguradora de Colombia. So you know what happened? All these reinsurance companies are super clever with their names. Swiss Re and Munich Re and China Re. Keep it simple.
I remember in Mexico, the Mexican equivalent was called La Alianza, wasn't it? La Alianza Re, which of course I think was acquired by Swiss Re.
It was acquired by Swiss Re indeed. So the Colombian reinsurance company was acquired by Swiss Re, and as a result of that, I joined Swiss Re. And I had the fortune then to move to New York and spend 10 years in the asset management division of Swiss Re. After that, I had different roles, predominantly across what we call corporate solutions, which is the commercial insurance arm of Swiss Re. And I run the Latin America operations for them. I run US and Canada. And then right after the pandemic, I decided to move to our reinsurance business. And I relocated to Beijing to run our Chinese operation, which is second largest market unit for Swiss Re. I spent some wonderful years in China. And then a year and a half ago, as part of some leadership changes at Swiss Re, I relocated to Zurich to run corporate solutions. So that's my journey into insurance.
Well, you've taken us right up to date. And well, it's not a bad career path because, of course, your predecessor, we know where he's ended up. So, and of course, he was also on the podcast. So we're filling in all the blanks in your career, Ivan. So you've been looking after Swiss Re Corporate Solutions for a while. How do you want to be perceived by brokers and clients when they're out there thinking of your name?
Yeah, so for me, the starting point is you have 30 to 50 commercial insurance companies globally. And if you want to stand out, if you want to be different, it's not that straightforward. And at the end of the day, for us, is to leverage the brand, the knowledge, the history of Swiss Re, and become a specialized risk partner for mid and large size corporations. And that basically means that when they interact with us, there will be some differentiation. It could be in terms of innovation, it could be in terms of knowledge, it can be in terms of service, but we want to try to stay away of being a commoditized market. There's many players for that. We want to be somewhat different, somewhat special, if you can call it like that.
A player that people want to seek out.
Yeah, because when you deal with our clients, less and less they're interested on the risk transfer element. Of course, it's very important. But I always say, if you look at the role of a risk manager in a Fortune 500 companies 30 years ago to today, that role has changed significantly. Before it was reporting somewhere in a finance division, treasury, or somewhere to buy insurance, limits, how much you buy, make sure that you had some sort of protection. The risk manager today interacts at CEO level, board level. You need to talk about geopolitics, supply chain, energy transition. I mean, it's a very wide role. So when they interact with the insurance industry, it's not just, quote unquote, just about the risk transfer element. They want to know risk insights. They want to discuss with you how they approach certain topics. And in that context, it becomes a much different approach than the traditional role that insurance had. And we want to be at the leading front of that discussion.
Maybe this explains the next question I'm going to ask you, because looking through a lot of your financial statements and presentations, the portfolio that you're managing has got a greater proportion of what you describe as decorrelated and differentiated propositions. Is that what you mean by the differentiated proposition? First of all, kind of explain to us what you mean by those terms.
Yeah, listen, to put it in perspective, we are part of one of the largest reinsurance companies in the world. And when you look at Swiss Re's earnings, the commercial insurance arm is around 20% of it. In the past was less than 20. In the future, we hope it's going to be more than 20. But the reason I say that is because you need to go back and understand, why did Swiss Re create a commercial insurance company to begin with? And the history goes back to the mid-1980s, when there was a liability crisis in the US. Fortune 500 companies could not find capacity, and they ended up going directly to the reinsurance market to have those conversations. At this same time, the same companies started to become more sophisticated in their risk management, and they realized that a big part of the risk that they transferred to the market was in the balance sheet of reinsurers. So they also wanted to have a conversation with the ultimate holder of the risk in the balance sheet. That's how Swiss Re started basically doing business with large corporations. And the beginning of our business was very much in what we call excess layers, follow market, very focused on wholesale hubs like London, of course, but also New York, at that time, Hong Kong. And we have evolved significantly from that into what we are today, which is a $9 billion business where what we call leading capabilities, primary capabilities, are very, very important for us, because we want to be close to clients. We want to be close to brokers. And historically, we've been a very P&C weighted company. So when we talk about differentiation and decorrelation, two different things, but maybe to start with the differentiation, I mentioned to you that we compete with 30 to 50 markets, depending on geography, line of business. And we want to find niches where we compete with less and where we can have a bigger influence in the market. And one example is the international or the multinational program space. This is a $70 billion market, largely to some extent an oligopoly when you think how many players can deliver to multinational companies coverage, policy issuance, claims all over the world. And Swiss Re decided to enter this space around 10 years ago. Today, we have one of the leading platforms and networks out there, and that is differentiation. And we bring something that very few can offer. The other example is the alternative risk transfer space. It is an $8 billion market. You probably have 3 players right now. The list is growing, but there's a few players that can do effectively captive solutions, parametric solutions, cat bonds. And we are on the leading front there as well. So when we say differentiated, it is something that others cannot do, and a market that is not 50 people chasing the same business. That's one thing. And when we talk about differentiation, is that we also have areas of our portfolio. One is credit and surety. The other one is accident and health, where these markets have their own cycles, and they're completely decorrelated from the P&C cycle. And we're seeing that in many ways at the moment. So when we look at our portfolio and we allocate capital into what we call the target liability portfolio, we want to grow credit and surety more. We want to grow accident and health more. So that's what we mean. This business, and an aggregate, was less than 50% of our business in the past, and is going to be more than 50% of our business in the future.
That's really, really clear. Yes. Talking about that cycle, obviously, yes, it seems that accident health does move in a different cycle to the rest of P&C, and obviously C and P also move differently from each other. And that seems very, very clear.
Yep.
In general, though, within P&C, we've got lower pricing and greater competition is here and is in the prospect going forward. What's your feeling generally about where we are with price adequacy? And also, how are you going about changing? We've had this harder market for a few years. How do you go about preparing the underwriters for a different kind of market, a softer market, more competitive one?
For us, and for many, obviously, that have been in this industry for a long time, you get used to these cycles. You understand how it works on the way up, on the way down. And the starting point, even before talking about price adequacy, is about risk quality, risk selection. Price is, of course, very important, but the price on its own is not the most important thing, because when you look at terms and conditions, you can have the best pricing in the world, and if your terms and conditions are very wide and not in line with the risk that you're taking, it doesn't really matter. And it also works the other way around. So I think for us is having a bit of a long-term perspective of knowing where we are in the cycle, recognizing that at this moment in time, all else being equal, with the pricing that we have today, the terms and conditions that are available today, this is still attractive business for us to deploy capital, and it is attractive business for our shareholders. We're very mindful that the market is obviously very fluid, and this can continue to move in one or the other direction. And for us, is being able to respond to those trends. But very importantly, as you said, is how can our underwriters make those decisions? And there is on one hand the very kind of macro views, macro trends, but when it comes to working on one account and renewing or trying to get that new account into the portfolio, it comes down to the underwriters. It comes down to their expertise, their knowledge, but also their ability to make decisions that sometimes will be influenced by what's happening in the market, sometimes is influenced by what's happening in their own portfolios. And as you said, the fact that these cycles are somewhat long, you have people that maybe started their career in a very soft cycle, and then they are dealing with a hard market. They might not know exactly how to position themselves, and the other way around. So I think that constant active dialogue, bringing perspective, showing that things will always change. That's the only thing that is constant in our business. Things will always change. And it can be 3 months, 6 months, and we're talking about something completely different, given whatever scenario that plays out over time.
So having more of that decorrelated business is a good thing, and it insulates you from the vagaries of the market. One of the commentaries in the marketplace, this is from the reinsurance renewals, that reinsurers could understand why it was softening, but they were surprised that it softened at a faster rate than they were expecting.
There's definitely a lot of truth to that. I would argue that when people put together their business plans 2 years ago or a year ago, they made some assumptions, and those assumptions are probably not holding up much or as strong as they thought. There's always a question of why, and there could be the availability of capital. It can also be how business is distributed and traded, which is much faster than in the past. Technology, of course, accelerates some of that, and you see that in the different broking houses, you see different wholesale markets. So that for me is expected in a way. I think that that's how our business develops. The biggest question at the end of the day is, how are we as an industry serving our clients? Are we addressing their needs? Are we making sure that the different situations that they face in their own businesses are properly mitigated by the industry, which is ultimately the role that we play? That for me is a much more important conversation of if rates went up 2% to then go down 4% to then go up again. I think that that's something that the industry loves to do, but I try to have a bit of a much more broader perspective and think about our clients.
But it is really interesting you saying perhaps, that the increase of speed. I suppose as a market, we're going to learn what the new price could or should be quicker than we would have done before. We can calculate so much more quickly. We can see the data more quickly. We can see what a fair price might be. And therefore, as a competitive market, if somebody wants to give a discount, they can probably move quicker than they would have done. But anyway, having said that, you've got a great global view of everything. Where are the best places for profitable growth looking in 2026 and beyond?
I'm very well aware you have a very big audience, and I'm going to tell you where we find the profitable areas for growth.
You don't have to give me all your trade secrets, no.
But then, no, listen, I think that when you look at our business from a global point of view, not to the surprise of anyone, the US is a big part of our business. Almost 50% of our portfolio is in the largest insurance market in the world, and that will continue to be the case. Therefore, for us, allocating capital to the US, investing capabilities in the US, hiring people in the US continues to be a very, very key priority. Next to that, you have the development of the London market, where everyone, of course, has a view. People love to talk about London. But we see that, first and foremost, from an insurance point of view, I joke that London is the 51st state of the United States, simply because the great majority of the business traded in London comes from the US. Therefore, for us, it's an important consideration to understand and see how we position in that dynamic, and ultimately, how can we better serve our clients. Germany is an important client and market for us as well. It's our third largest market, Germany. There's a lot of structural changes happening in the German economy, and we feel that those clients need us more than ever. And then I'll probably just close the geographic consideration with Australia and Canada, which are historically big markets for us as well. But I can keep going. Of course, we see opportunities in France. We have a great joint venture in Brazil. We have a growing presence in Asia. Geographic always is a starting point for us because we do global target liability portfolio, as I said. Therefore, we have a very clear view about the profitability of the lines of business. We just want to understand in which markets we believe we can have a higher return. And at the end of the day, is competition for capital.
And what about in terms of specific lines? For example, I've done lots of podcasts recently, and you probably, if you picked up any of the insurance media in the last 6 months, you'd have read all about this huge demand coming in data centers. Obviously, you're talking about restructuring economies, a lot of renewable energy, some of that's to power all these data centers. It seems to be fascinating a way that we're resetting. Have you seen some of that? We're talking about really explosive amounts of demand and trillions of dollars of investment, some of these vast risks coming on stream, or at least beginning to be constructed. Are you starting to see some of that demand? Because obviously there's a lot of talk at the moment, but I haven't really seen, many spades in the ground and many actual premiums being handed over.
I would argue maybe a year ago that was the case. I think right now you see much more concrete plans. You see much more concrete demand. If I can take us back for a moment, I would argue that a lot of what we're seeing, both in terms of opportunities, but also considerations, relates to this triangle between geopolitics, energy, and technology, and AI specifically. And when you look at the three combined, you start to see where the opportunities come. And I think that for us, clearly energy has been one of the leading businesses for Swiss Re as a group to begin with, both in the traditional energy, but also in the new energy. Engineering and construction is naturally another area that we have been investing quite heavily on. And those two together, in the context of what you just said, becomes very, very important. And not only in one or the other country, these are now global themes. And we get approached by brokers, of course, but also clients directly, or by investors that have the next data center project being constructed in X or Y country. So this is a very live conversation. Because of the numbers that you mentioned, the scale, I think that it is an opportunity for the industry, but also a challenge for the industry to be able to respond to all those needs. And how do you do that in a coordinated way? As an insurance company, we play a role, but Swiss Re as a reinsurance group plays an even bigger role. So our reinsurance colleagues spend quite a lot of time on this as well. And maybe moving on from these two themes of energy, engineering, and construction, the natural catastrophe property area continues to be one that inevitably we will see more and more demand on a global basis. I think we all highlighted, despite the fact that last year there was not a quote unquote big Nat Cat event, and probably California wildfires don't get to that level despite the very big severity that came with it. There was a lot of activity globally, and the numbers add up very fast. And I think that, of course, will continue. And then the last point that I mentioned at the beginning was credit and surety. We announced a couple of weeks ago the acquisition of the credit and surety business of QBE, which is a step for us into the trade credit business. We also see quite a number of attractive opportunities there.
Do you think with these data centers that it plays very well to you as a large part of a very, very large group? Because this is a kind of consensus capacity type risk. It sounds like some of these really big ones are going to be the ones where almost the whole market has to agree to all risk their capital together. And would that be about right to you? For me, I mean, if I was a broker, I'd be thinking, goodness, if I was talking to my client, I wouldn't be talking to them about trying to solve their problem by getting this place, but I wouldn't be raising any expectations at all about it being particularly competitive, because I would kind of imagine this is a capacity risk where I need almost all the market to be in agreement. And of course, to get all the market in agreement, you probably have to pay a slightly higher price than you would do otherwise, as a broker, where you can't really generate as competitive a market as it would be otherwise. If it was, if it was 10 times smaller.
Not necessarily. And the reason I say that is because, yes, these are big numbers, the big capacity, but it's not particularly different to other situations in the history of risk, where ultimately, to begin with, you're going to need lead players. You're going to need people that have the knowledge, the risk insights, and the capabilities to put out the terms, the conditions, the pricing of the risk. And then after that, you start to build the rest of the capacity. And then you obviously bring many, many follower markets. Swiss Re's strategy as a group is to lead. We say we're built to lead. Therefore, this conversation for us is not too dissimilar, other than the scale, to other conversations where we bring the 163 years of history of Swiss Re on risk. We analyze, we give our opinion, we have great data and modeling, and we can then have a thoughtful conversation with the client and with the broker about what we think. And then once things are finalized, then we invite a number of players, and the brokers do a lot of this, to find a lot of quote unquote follow capacity. But that follow capacity basically just provides the capital. They have less of an influence on the structuring or on any of the other considerations.
What do you think to this trend? The trend among brokers, say all the top 10 brokers in the world these days have, obviously starting in the London market, but we can see this is going to be a global phenomenon, facilitating a percentage of their business flow. And again, within markets like Lloyd's, are seeing very much increased use of consortia. And of course, backing some of that is the phenomenon of portfolio solutions underwriting, i.e. that you've got underwriters who are specifically specializing in backing those facilities or backing those consortia and whole account type operations. How far do you think that could go? Obviously, and you've mentioned there, of course, a Swiss Re as a leader with a huge amount of skin in the game and great expertise, great engineering, great data, great understanding of the risk, and obviously putting down a very big line as well. And obviously, you've also got that experience in the alternative capital markets, which you've alluded to. Do you think that makes a lot of sense? We'll be seeing a Swiss Re consortium, Swiss Re-led consortium, which is billions in capacity, that kind of thing. Leveraging your expertise and getting that capacity almost lining up behind you before you talk to the client.
Yeah, as you mentioned, maybe a couple of things that I want to highlight. And I think at the end of it is a bit the convergence between technology, capital markets, and data analytics. The three things together are fundamentally different than 20 years ago, fundamentally different than 10 years ago. So I do think that first, it makes sense. And second, you will see more of these efforts to leverage these three areas to ultimately have an industry that is faster, more efficient, and ultimately more effective. That's happening. I think that's going to continue to happen. Now, the ultimate question, once you go through this journey, is going back to what I said before, which was the client. And how do you make sure that a lot of these efficiencies and gains are translated to the client and that they just don't stay in the value chain of insurance? Because ultimately, I do think that the industry will continue to get better and better and better at identifying, managing, and mitigating risks. And you just need to make sure that the connectivity across this value chain is strong enough that ultimately the client can benefit from it.
So we should probably expect to see more. Is that the right way of interpreting what you've just said?
You definitely should expect more of Swiss Re on the leading front. There, I think you're going to see us very active, both in terms of bringing our insights to the market, but also bringing our capital. That's definitely going to be the case. When it comes down to pure following from a commercial insurance point of view, you might see us tactically here and there. We also have an important follower book, but strategically, our priority is going to be leading, without a doubt.
So it sounds like, yes, we're more likely to see you leading some of these consortia and then wielding some of that capital, perhaps on behalf of others, almost binding them along with you.
Yeah, very few can lead, many can follow. So we want to be on the very few, not on the many.
Well, occasionally when an underwriter, somebody's got an extra skill or distribution, understanding, or often it's niche things, would be distributing via MGAs. So where you're giving the pen to somebody else and saying, you know what, you're really good at fish farms, or the weirdest one I heard of the other day was drying fish in Scandinavia. You make the kind of, I don't know, dried cod or something like that. And then you dry them out in the sun, of course, and they can just blow away. If you have a storm, it can be not good. So
I heard a lot of stuff, but I haven't heard about that one. That's an interesting one. Now you piqued my curiosity.
Interesting, kind of wind-related risk, I think, and or maybe too much sun is bad as well. I mean, and then of course you don't want it to rain too hard on the dry cod. But again, those are classic examples of where MGA distribution can be really effective and efficient because perhaps it's almost too small to interest a business like yours. So obviously a lot of carriers are availing themselves of this. We've had a boom in MGA formation.
Sure.
Are they part of your strategy or not? And if they are, what sort of MGAs are you looking for?
So I'll be a bit guarded here with my answer simply because I have many friends at MGAs and many partners who have historically tried to do business with us. But listen, I start by saying that exactly for the reasons that you highlighted, there is a role for MGAs to play in the market. That's unquestionable. Now, whether that is something that benefits a client or benefits a carrier, that's a much more open question for debate. But at Swiss Re, we've had historically a partnership with some MGAs, some successful, some less successful. But I do think that for me, they're more tactical than strategic. If I tell you that we want to be in front of clients, if we want to lead, if we want to do all the things that I just told you before, I just question how can an MGA support that goal. Again, it doesn't mean that we will not do business with an MGA tactically if it is because there's a specific product niche, as you referenced before, or the specific access to a segment of the market or a geography that maybe we don't have on our own. But maybe contrary to the flavor of the day, where you have carriers, which is pretty crazy when you think about it. There's carriers that have north of 30% of their business through MGAs.
Yeah.
I'm just not 100% sure how that franchise kind of evolves, but that's for other people in future podcasts for you to invite to explain why they're doing what they're doing. But just to cut it short, I think that MGAs are important in the market, yes. Strategically, for us, not as interesting. Tactically, potentially an option that we consider, and we have some very strong MGA partnerships at the moment.
When you say tactically, things like an emerging new class of business, for example, like cyber would have been 15 years ago, I suppose tactically it can be a very useful way of getting some exposure. Of course, everything new is diversification as well. So it's ultimately, you get diversification benefits of doing this stuff, but also you don't have to invest in the team yourself, and you can learn about the class of business as it develops, and they get to make the mistakes. And obviously you have to pay for them, but you don't have to pay 100% of those mistakes. You get to share that with the rest of the market, and you're all learning as the business is growing. And then would that be a tactical reason, for example, if there's a class of business?
That probably fits into the category. I can think of many other potential options around it as well. But in principle, yes. But the thing with tactical steps is that they're not really for the long term. Otherwise, they will be strategic. And as I said before, trying to get this right in terms of the tactical steps, yeah, you can argue you learn. But if you learn by paying hundreds of millions of dollars of losses, maybe there was better ways to learn, or maybe you should have not learned anything to begin with. And that's a little bit of debate. But as you can hear a little bit from my positioning, which is personal one, less of an institutional one, I'm somewhat skeptical that particularly this chapter of MGAs, where you have some that are far, far, far away from the niche, special product, the special market. Some are just plain vanilla MGAs that do the same thing that the carriers do and can do. And there I just wonder how that is going to work out. But that's for others to solve.
So your instinct is really, if I think this is good business, I should be underwriting it myself, and I want to be leading it and really going for it. And because if it's genuinely strategic, that's the way I want to approach the business.
That's how we prefer to spend our money. Yeah.
Well, obviously, you mentioned your own acquisition of the trade credit and surety division of QBE around this time in the cycle. And obviously, we've started to see it. It's happened quite quickly. And of course, it's a bit like waiting around for a London bus. You wait for ages, and then suddenly 3 or 4 suddenly all come along, and you wonder why, why I've been waiting for 20 minutes, and then suddenly 4 or 5 come along. We've had a bit of a flurry of carrier M&A.
Yeah.
Obviously, you've shown that you can consider inorganic growth as well as organic growth with the acquisition you've just done. Obviously, it's not that transformational, but it's more of a bolt-on. But again, what's your view on that? Obviously, we should always look at Swiss Re as being a potential acquirer. Obviously, they're never going to be the acquired in this situation. When we see the market softening and these opportunities coming up, of course, partly that's down to timing and who owns some of the other assets who are your competitors, that some of them we know will be looking to sell at some point. Again, you've shown that you are a buyer. What's your kind of view strategically about this? And obviously, you can only buy when things are available to buy. And we know that things are now becoming available to buy. So the question is, what's your view?
One thing I should have said at the beginning when you asked me about my career at Swiss Re is I should have dated a bit myself by saying that I've been at Swiss Re 25 years, which means that, like you, we've been in the market for a long time. And history never repeats the same way, but it tends to at least get pretty close. And you just asked me a question on MGAs, where we have seen this movie many times before. We know how it ends. And yes, there's going to be the exceptional great MGA, but by and large, I think a lot of people are going to struggle once all is done and set. And M&A is slightly similar because we've seen the same waves in the past and we started to see them play themselves now. And the 2 questions are always around value creation and execution risk, if I can call it like that. And if you look at the last cycle and some of the M&A that happened, I think the majority created no value. In some cases, destroyed value. In some cases, destroyed franchises of great companies that are not here anymore because someone with great ideas in the middle of a soft market decided to come and pay an exorbitant amount of money and then failed integrating it and completely basically destroyed what it was at that point, a great company. We've seen more than that than successful M&A in general. And the other one is what I mentioned about the execution risk of how do you integrate these companies. So what we've seen in the last couple of months is some deals that at a high level strategically appear to make a lot of sense, add values that when you look at any metric or any consideration appear to be pretty expensive for the buyer entering the cycle we're entering. And the question now for a lot of these companies going forward is how they're going to manage the integration risk. So that's kind of at a high level how we see it. Now, when it comes down to Swiss Re, we're very mindful of the three things that I just said. We want to be very disciplined. And yes, we see that inorganic growth can accelerate our franchise overall, which is what we just did with credit and surety for QBE. And we will continue to look at opportunities, but we will be very disciplined because we're all going to be in these roles for some time. And I don't want to have my successor in 5 years cleaning the mess that I made.
Sounds like we should be expecting more. I don't really like the words bolt on, but that if we say describe adding, enhancing capability by buying QBE's trade credit and surety division is a bolt on for you, isn't it? It's effectively
correct.
It's not something that's transforming the nature of Swiss Re Corporate Solutions as it faces the market, but it's enhancing your position, your competitive position in that space and giving you capabilities that you didn't have before. So which we expect, if we're going to see you as an acquirer, more like that rather than acquiring a massive brand name, which is in 20 different markets that you're also in, that kind of thing.
I think that's the right description, yes.
You've been mentioning about this triumvirate of the geopolitical risks, the technology and energy. On the technology side, I've just come from some really interesting insurtech events in London. That, it was actually the Lloyd's Lab. One of the themes was AI. And there were about 4 or 5 companies pitching on the same day, talking about ensuring AI as a risk in itself, or almost the efficacy of AI, or the liabilities, the specific professional indemnity, errors and omissions type liabilities that AI may be causing in the world. What do you think about this? I mean, we could have been talking about cyber 15 years ago, which emerged from whatever it was, computer crime from the 1980s. I do remember having seen those policies, but no one ever bought it. Do you think we're on that kind of moment with AI? What's your gut feeling about it? It seems very interesting. But at the same time, of course, AI is currently effectively included in most casualty policies because it's not excluded. So it's a silent risk. What's your view? Do you think it's got the potential to become a standalone class in its own right?
I think it's going to take time. I think it's going to potentially eventually get there. But I think that if you look at AI in our industry, there's probably 3 or 4 steps before that are going to be really transforming how the industry operates today. And we already see some of that in terms of more efficient operations or faster claims processing and things of that nature. And you rapidly start to see some adoption within underwriting. And eventually you could think about something about what you said eventually happening. The biggest question, however, and the biggest test for the industry relies on data and data management. And I don't think the industry has a good starting point on this one as a whole, because you can have the best models and you can bring it to your organization. But if your data is all over the place, you don't even know where the data is, you don't know how to aggregate the data, these models are going to be somewhat effective, but they're going to be significantly below the potential that they could have if the data was organized and managed otherwise. And it reminds me a little bit about during the .com and then a bit of the insurtech, quote unquote insurtech, which is a funny term because it was a lot of insure and very little of tech. That the insurtech wave had these companies that were, and I cannot say names to be respectful with those companies, but they will come and say we're the new insurtech digital company, and they had this beautiful website and you could go and do all these things. And the moment the deal was pretty much quoted, it will go from the beautiful website to this clunkiness of systems and 1930s kind of platforms and things that were not connected, no interface. So it was a bit of a fake insurtech in a way. I'm a bit afraid that parts of the industry will go through a bit of a similar journey with AI. They're going to have this shiny thing at the front. They're going to say everything is AI. And the moment things need to get done, you're going to run them through horrible systems that will take a lot of that away. Now, from a Swiss Re point of view, we've been very public that we've invested heavily in terms of aggregating our data and having the ability to leverage that data. We mentioned publicly as well a partnership that we've had with Palantir to be able to bring all of this together. And we believe, of course, it would all be tested in the future, but we believe that we're in a great position to leverage the benefits of AI from an end-to-end perspective. I think a lot of people are going to start, but they're going to be caught in the middle, and they're not going to be able to bring it towards the completion.
Yes, I was looking in Swiss Re investor presentation, And it said of gains of your own, we always talk about 80-20, don't we? But there was an 80-20 here, was 80% productivity gains and 20% loss ratio improvement. So I suppose talking generalities, we're talking about 80% efficiency gain, and then 20% of it is underwriting skill. Do you think we're going to go to a phase now where will that underwriting skill percentage of which is only 20 at the moment, do you think it's going to start to go up? If you've solved your problem of data, so you know where your data is, you can really trust it, you can really let loose those agents onto it and start to see insights and start to see which risk is better than another risk, etc., ones that may look similar, but they are not. Do you expect that skill, that 20% of loss ratio improvements to start to go up in terms of the benefit of AI? For me, I suppose it's the next frontier, isn't it? The first part, you've done the first part, which is get your house in order.
Yeah.
And get all these, unstructured things structured so you can really look at them and compare like with like. How are we going to become better underwriters because of it? And do you think that's the next big benefit?
So in the case of this analogy that you made for our investors presentation, it could have been a specific case. But when you look at the overall, from a pure underwriting perspective, some immediate things that we can see now is the margin for human error, as an example, goes down quite significantly. So you should expect that we will see some improvements in that. Very difficult to quantify from a loss ratio point of view, how much of that we think is going to get better. But inevitably, we will see definitely some improvements. Clearly, the modeling that Swiss Re has had historically, which is proprietary modeling, will now be enhanced by the ability to leverage even more powerful and more broad models that are out there that, in a way, should also help the underwriters make better decisions as a consequence of that. So I do believe that over time, there will be improvements from an underwriting point of view as well. I just don't think, as I said before, that they're going to happen immediately, but the direction of travel is straightforward.
And with the way you're implementing this, presumably there's always going to be that Swiss Re human in the loop there. There's always going to be the underwriter. This is going to be something that's enhancing that underwriter's effectiveness, efficiency, and also skill, but not replacing, I presume.
Most likely. And again, keep in mind that we focus on large, complex risks where it's going to be very different underwriting than if you're doing, to use an example, personal lines, where you can probably do a lot of algorithmic underwriting and be able to have agents use that. And you probably start to see that already in some angles on the industry. I think for us, there's always going to be a level of complexity that I do believe that the underwriting, we always say, is a bit more an art than a science. So the art part still probably going to be a bit dependent on our underwriters to be able to make some of the most fundamental decisions.
I suppose at least in this world, the feedback loop is so much quicker. So you're always going to have to make some kind of an assumption, but at least you'll find out the facts quicker to see whether your assumption is correct or not, and you need to make amendments.
I would agree with that, yes.
But to go back to that very first question, because AI is such a big topic, what's your gut feeling about AI, particularly AI casualty and AI professional indemnity, errors and omissions as a standalone? Do you think it's got the potential to become a standalone? And of course, the other question within that is, what often causes something to become a standalone is for either regulators or, let's say, the de facto regulators of the insurance industry, one of them being Swiss Re.
Yeah.
If you decide to make that a universal treaty exclusion, then you do effectively create a standalone class of business on its own, don't you? Because, if they want to write it, they have to actually name it and write it back.
Yeah, listen, I think that is so forward-looking that I don't even know how exactly it would play itself out. My sense is just look at the overall liability market for a moment, look at cyber, look how much they've developed or how little they've developed, depending on your view of the world, that a forward-looking AI-specific kind of a coverage, you can never say it's never going to happen. I just think it's going to take a long, long, long time.
And at the moment, everything's embedded already. It's a bit like, I don't know, in 18-something, the underwriter said, I'm excluding telephones because they scare me. I don't like the way people just make contracts with each other without them writing them down. Whereas before, you'd write me a letter and then I would say, yes, we could agree what we had written and we could take it to the court. And of course, then you say, now I can say hold covered on the phone. And then, of course, it's terrible for errors and omissions. And I suppose telephones became so embedded in the world, we didn't have a universal telephone exclusion. And I suppose now you've got lawyers E&O or architects and engineers E&O, for example, and we want our engineers and our architects and our lawyers to be using AI to be more efficient and to maybe to come up with better insights and come up with better designs and whatever. So I suppose because it's so embedded, just like a telephone, we can't really exclude it.
Yeah. I go back a bit to where we started as well in terms of ultimately thinking of the client. What is the client needs and how can the industry serve better those clients. I think that's ultimately what's going to drive this discussion in my mind.
So it's going to be more about risk management. It's like, hey guys, we know you're using AI, but here's our guidance on how you should be using it and how you should not use it. And obviously, if you ignore all our guidance and you have a big loss because of ignoring our guidance, we're not going to be very happy with you. So you don't expect us to be your insurer much longer. I suppose that's always the best way of dealing with things.
The good thing is we're going to find out. Maybe not you and I. It might be a bit too far down the road, but we will find out.
The other lesson that we are learning is that we always seem to find out quicker than we thought. It doesn't take so long to find out. Everything is quicker.
We will see.
The very last thing, to go back on the MGA question, when you were talking about MGAs being, some of them being quite vanilla and just reproducing what everyone else is doing, do you think there's necessarily a bad thing when technology is now enabling the value chain of insurance and reinsurance to be split up? Whereas before, when we were starting our careers, if you add another link in the chain, you add 10% cost, and then of course 3 or 4 months delay, and then even the premium doesn't get delayed, and you have bordereaux, and you think actually you better pay for that by being 10% better on the loss ratio for a start, by being really skillful or having something really specialist. Whereas these days, of course, with the technology, if we're all looking at the same data, all looking through, and we haven't added that extra friction, do you think it is possible that the skill of underwriting could be just disaggregated completely from that value chain, and so you could just be a skillful underwriter but have your own underwriting company and be happy without adding extra costs and without adding extra delay or misunderstandings?
So you're asking me to say that with technology, the role of MGAs become less relevant? Is that?
Well, it could be more relevant because, just because there's always going to be an underwriter, I suppose. I suppose there are always going to be people who want to work for themselves.
Yeah. No, listen, all jokes aside, I would argue 100% yes. And again, I don't want our friends in the audience who are in the MGA business to come across overly negative to what I'm saying. But the insurance industry should aspire to be very efficient from an end-to-end point of view. And as I said before, in that efficiency, there's probably room for some MGAs. But if I look at the number of MGAs out there today, that's probably a show of inefficiency somewhere in the system. And time will take care of it.
Yeah, ultimately, that your net premium is your net premium. And if the net losses exceed the net premium, you're not going to be happy.
Absolutely. And again, it's always about the client.
And it's not sustainable anyway. What's not sustainable? And of course, there's a value chain for a reason. All that work in the chain has to be done by somebody. And, if you try and cut people out, of course, then you have to do the work, whatever they were doing. Sometimes you can cut them out because they weren't doing any work, but there you are.
Of course. But you know that for every dollar a client buys from insurance, a lot stays somewhere. And I would assume that over time that tends to even itself out.
I suppose we hope that over time it tends to be a lower number.
That's the goal.
As close to zero as we can get it.
The industry is here for the clients. I think we need to make the life of our clients better. That's the ultimate goal here.
Ivan, I think if you do that, then you're going to be successful.
Well, we're trying every day, every day, every hour. No, listen, I mean, we've talked a lot about the role of the industry here, but the reason you have this podcast, the reason I join and others is I think we're passionate about the role the industry plays in society. And we say at Swiss Re, the mission of the company is to make the world more resilient. And that's not really PR. I think that's really how we feel at Swiss Re and what we hear every day. So ultimately, of course, in a more complex world, insurance needs to play its role. And we at Swiss Re will do that to the extent of our abilities, for sure.
Well, Ivan, I've really enjoyed talking to you. It's been one of those conversations. I wish it was face-to-face, actually. I think it would be much better if it were. And when we could go for a beer and, on the lake afterwards. But never mind.
Follow up face-to-face with a beer. I would love to do
very
that.
Nice, because there's that lovely bar at the end of the pier, which is very nice, opposite your office. I must go back there soon. But until then, Ivan, thank you so much. I've really enjoyed the conversation. Thank you for your time.
You're very kind. Thank you for having me. And to your audience, thanks for listening. I've listened to many of your podcasts in the past, and it's really enjoyable. Difficult to explain to people that you hear to insurance podcasts. But for us who are in the industry, we love it. So thank you for doing what you do as well.
Thank you very much.
Have a good one.
Well, I hope you enjoyed today's episode. If you did, don't forget to subscribe or leave a like or a review or recommendation on whatever podcast platform you used to access this program. These really help get the word out. Before we go, just a quick reminder that advertising slots are available here and in other places in the Voice of Insurance podcasts. Podcasting is the fastest growing medium and attracts a high quality audience of key decision makers. It's also an intimate medium where you, the listener, are right in the room with me and the interview subjects. Needless to say, that means it's a great way of getting your message out directly to an audience because you know you've got their full attention. It's also very cost effective. So get in touch with Mark at thevoiceofinsurance.com to find out how you could be speaking directly to the industry. The Voice of Insurance podcast is produced in association with Advantage Go, enabling enterprise-scale underwriting through a single pane of glass. Voice of Insurance is produced by me, Mark Gagan. Music was written by Anna Gagan and produced by Carlos Gagan. Check out more podcasts and written comment pieces at www.thevoiceofinsurance.com.